We welcome Dan McClory. He's the Managing Director and Head of China for Boustead Securities. Good to see you, my friend. So, you know, I've got mixed feelings towards this because I feel like Powell has been saying the same thing over and over again. It's just we as investors really didn't want to listen to it, and maybe we're just being overly optimistic, but he said it again today that more clearly, more succinctly, and the markets really did not like that.
They didn't at all. And when Powell alluded to pain, I didn't think he believed it was going to be as immediate and thorough as what you're referring to with the meltdown of the markets today. So it's already put things into a world of hurt. And he's definitely taking a much tougher tact than was in the past and than was anticipated. But, you know, this is his legacy, Phil. This is what's going to define him. In large part, it's going to be part of the Biden administration legacy as well. And you've got political undertones to some of these things. So it's a tough call. It was some tough medicine, and the markets reacted accordingly.
For those that don't have an economics degree or a market expert like you are, explain to the average person why they should care that interest rates might go up 50 or 75 basis points, or for that matter, any amount. Why is that such a big deal, and how does that impact sort of the everyday person?
So it definitely slows overall growth. So it takes some of the gas out of the economy. It starts to press the brakes. So if money and capital is more readily available at lower costs, businesses can grow and expand. When it's more expensive, they think twice about it. It also causes the correction that we saw in the stock market today, because if the thinking now is that interest rates will go up, then maybe going into bonds, maybe going into debt, as opposed to buying equity or shares in companies, maybe that's the better ticket. And so investors, you know, they vote with their wallets, and that's kind of what they did today.
Yeah.
Negativity on equities.
We had a huge party, for lack of a better word, over the last couple of years, because money was basically free and we thought companies would grow forever. And I think today we got a bit of a rude awakening that that party is, according to Powell, in for some pain. And I haven't even brought up the issue of the Federal Reserve and the Treasury Department doing some quantitative tightening. And I know that's a technical term for a lot of our folks, but that also takes away money from the overall economy as well. So a recession, in the last report said, well, we were on the edge of it or near it. It's a real possibility, right?
It really is. I mean, if it was ambiguous or unclear, I don't think it is after today. I think we're definitely headed towards a recession. I think we're headed towards perhaps 4% Fed rates. You know, they're gonna keep increasing. And remember, Powell misjudged the state of play going back as late as November. He thought, conventional wisdom thought, as we heard prior to this segment, that it was the COVID stimulus money and it was also the supply chain disruption that were causing these price increases that were fueling inflation. We've learned that it's far more than that, most specifically energy, and how that's a huge piece of inflation and demand and availability. So yeah, I think if there was discussion about a recession, I think it's clear that that's where we're going right now.
So on the good news, energy prices have pulled back a little bit among some other things in the overall economy, but used cars prices remain high, new car prices remain high, rents for housing remain high, and the overall housing market, albeit have slowed a little, still remains near an all-time high. So my question to you is, do all of those things have to come back to where we were near the beginning of the pandemic for this to sort of equalize, or is there a happy medium where the Fed might say, okay, it's pulled back X amount and we can stop hitting the brakes?
Yeah, Phil, that's a great question. There's got to be a happy median. If Powell is intent on taking it back to where it was, I mean, that pain is going to be far deeper and far longer term. So there's got to be some kind of a happy medium where you sort of step on the brakes and attempt to hit the gas at the same time. It's really tough to do. Try it in a car sometime. You spin out. So, but I think that's the approach that would be preferred, that we don't completely rip the bottom out of this economy and say, oh my gosh, we've got to go into austerity because the price stability, as he calls it, is of paramount importance. I hope there's going to be some moderation there, and I think there can be.
Yeah, and look, I know where you are down there, that the economy, I suppose, feels pretty good. Job market is very good. There's plentiful jobs for people who are willing to work. And overall, nationwide, we still see more jobs available than people actually looking for jobs. So here's a data point. If we're going to be data dependent, what number does this job have to be, or jobs or jobless have to be, for the Fed to say, okay, well, the economy has slowed down enough? Because that has to be a big part of the equation.
It really does. But you know, it's amazing how interrelated all of this is, because a big part of the tightness in the job market is people leaving lower paying jobs to seek higher paying jobs because they're trying to cope with inflation. So it's almost as if one drives the other. So we've got an incredibly tight labor market, but it's tight because people are leaving positions to become upwardly mobile in an effort to confront these, outsized increases in their cost of living. So I think it starts to moderate when inflation comes down. It almost starts to self-police. I mean, that would be the thinking of Powell, and how he's going to fend off people like Elizabeth Warren, who say we can't afford, job losses and we can't cut into employment. But there is going to have to be some give and take there.